Well, hello, everybody who's out there, and welcome to Lifetime Income Options in Retirement Plans. We're going to be talking about the challenges for ERISA plan fiduciaries. And we are very happy to introduce Mitch Shames and Dave Nolan from Harrison Fiduciary. So to get these things kicked off, I'm not sure who's going to go first. I think it might be Mitch. Is that correct? Okay. So Mitch, why don't you take it off? I know you've joined us once before, so we're hoping to get through your presentation and have some Q&As afterwards. Anybody who's out there in the audience, if you please use your chat, if you'd like to ask a question, we'll keep track of them and hopefully we can get to your questions at the end. So take it away, Mitch. Thank you.
Thanks, Debbie. Good morning to everyone. My name is Mitch Shames and I'm the founder and managing director of Harrison Fiduciary Group. I'm here with my colleague, Dave Nolan, who's the director of research. And we're here in part to share with you our hypothesis that lifetime income products are going to transform the retirement industry. Right at the start, just so that we're clear what we're talking about, lifetime income strategies or products are investment strategies which anticipate and provide for the payout of income either during retirement or beyond retirement. These income obligations are often funded by annuity contracts or similar arrangements. We recognize that annuities are not typically an area that people who hold CFA designations spend much time focusing on. So we are deeply appreciative that you've showed up, and hopefully we're going to make it worth your while. Briefly, we're going to cover who we are and what we bring to the table. Then we're going to bring an overview of the evolution of retirement plan industry, including the challenges that fiduciaries face in selecting lifetime income products. And then we're going to also end with a broad overview of the type of lifetime income products that are emerging and that will define the marketplace. Our goal is to provide a broad overview and key themes. We don't expect that you'll become experts in this new product line. We've been at it for close to a year, and frankly, it gets more and more complicated. So Harrison Fiduciary Group was founded on really a simple set of observations regarding the challenges facing fiduciary committees. First, it's not 1974. That's when ERISA was passed. Today, the investment options facing fiduciaries have become enormously complicated. It's no longer about simply making decisions and asset allocations among index funds. In today's world, fiduciaries have to understand active and derivative strategies, a whole host of alternative strategies, including hedge funds, private equity, venture capital, and real estate funds. And within those categories, as most of you know, there are even subcategories. Then we also recognize that plan fiduciaries have day jobs. They're senior executives, head of HR, legal, and finance. They are busy people with significant responsibilities of their own. Now, lifetime income products are being thrown into the investment mix. Frankly, plan fiduciaries are often overwhelmed by the complexity, which can lead to stress. We've developed a business model in which we can lift these burdens off the shoulders of plan fiduciaries. We do this by combining decades of legal and investment expertise, because in our judgment, being a prudent fiduciary requires, the integration of both of these skill sets. We're intentionally small. We only work with a select group of clients. And most importantly, we recognize that for plan fiduciaries, we're not just dealing with employees, but often with long-term colleagues and friends. Fiduciaries want to bring their best game to the table. But before we dive in, I'd like to ask a quick polling question. Do you serve on a committee which oversees an ERISA qualified retirement plan? So do we have results? I guess we're still tabulating. Okay, so I don't know if everyone can see this, but 18% of you do and 82% of you don't. Well, that is what somewhat along the lines of what we anticipated. We hope that we're going to raise issues that can help fiduciaries in making these decisions. But for those of you who are not fiduciaries, we love advancing the thought leadership in this area, and it is such a new area. We look forward to your questions and comments. So how did we get here? As you can see, DB plans go back to 1875. American Express set up the first plan for retirement savings. Then we jump forward to 74 when ERISA was passed and established a federal set of national standards for retirement plans. Soon after ERISA was passed, it was amended to provide for self-directed plans, which we know as defined contribution plans or 401k plans. And from the 1990s forward, there's been a huge shift from DB plans to DC plans. Our hypothesis is that 20 years from now, the industry is going to look back to the early 2020s as a fulcrum point in the shift to lifetime income plans. Stay tuned. So this shift is being fueled by a handful of factors. Back in the early days, traditional DB plans were funded largely through the purchase of annuity contracts. Effectively, insurance company owned this business. The passage of ERISA, however, introduced requirements of diversification and facilitated the entrance first of brokers and then investment management firms into the industry. Note, this diversification requirement was an explicit nod to modern portfolio theory, which was emerging at the leading business schools. As plan sponsors took on the management of their retirement plans by selecting and monitoring investment managers, the insurance companies lost their grip on this lucrative market. Lifetime income funds represent a huge opportunity for insurance companies to re-enter the marketplace. The industry is very engaged. There's also the development of fintech firms who essentially serve as the middleware, coordinating data that previously had been siloed in the banks, record keepers, administrators, investment managers, and plan sponsors. In fact, there's one product suite in which the middleware firm is a key partner both in the development and execution of the product. We've also seen a new language and new dynamics introduced into the discipline of human resources. Financial wellness. Financial wellness is now part of best practices of human resources, essentially reflecting the fact that workers are not simply employees 9 to 5 up until their retirement date, but rather they're human beings who have interests and concerns which extend past their retirement. Remember, in traditional DC plans, account balances were paid out upon retirement. At that point, employees were no longer, the problem of the plan sponsors. They were on their own. That approach is changing significantly. These factors contributed to the passage of the Secure Act in 2019. And before we jump to the specifics of the Secure Act and to understand the momentum behind these products, I think it's really important to note that in this period of intense congressional gridlock, the Secure Act was passed. My hypothesis is that the powerful lobbies of both the insurance industry and the investment management industry were key to the passage of this legislation. We talked about the motivations of the insurance industry, but there are really compelling motivations on the investment management industry side. I mentioned earlier that with traditional DC plans, account balances are paid out on retirement. But with life income products, balances can remain in the plans for another 10, 15, or 20 years. I don't want to sound cynical, but just a realist. Those are a lot of investment management fees that are on the table. Therefore, it's no surprise that these formidable competitors came together and it resulted in the Secure Act. In my judgment, lifetime income strategies are going to happen. They're here to stay. Too much is at stake to let this opportunity pass. And by the way, let's not forget, and as Dave is going to get to later, these strategies and products provide really helpful benefits to plan participants. So now we'll take a look at the Secure Act. When we look at lifetime income products, there are three primary fiduciary decisions which must be made: the selection of the annuity provider, the price of the annuity contract, and the terms of the contract. The Secure Act takes the risk of the selection of the annuity provider off the table. Essentially, plan fiduciaries will not be responsible for the selection of the annuity providers. The Act provides a safe harbor. As long as the annuity providers meet certain standards, run regular tests, abide by insurance regulations, disclose all of this to plan fiduciaries, and make annual certifications, there will be no fiduciary liability for the selection of the provider. The safe harbor effectively shifts the risk from the decision-making fiduciaries to the annuity providers. This is really a big deal. And I just want to pause for a second and shift now to DB plans, just briefly. Right now, with the increase of interest rates, many DB plans are going through a period where they're de-risking. They are purchasing annuity contracts. In these transactions, the selection of the annuity provider is a huge decision. And as I said before, in the safe harbor provided by the Secure Act, this decision has been removed from the shoulders of the plan fiduciaries, and therefore has removed a significant impediment to the introduction of lifetime income products. The industry, no doubt, let out a huge sigh of relief with this legislation. I said there were three decisions: selection, pricing, and terms of the contract. The safe harbor only goes to selection. Plan fiduciaries are not off the hook for pricing and the terms of the contract. The analysis must be rigorous. With respect to contract terms, it's important to remember that annuity contracts are regulated by the states. There's no single federal standard. Each annuity contract can be unique. Just compare this to mutual funds, which are completely standardized due to the Investment Company Act of 1940. With respect to the structure, effectively the terms and conditions, you know what you're getting. Not so with annuity contracts. As for pricing, the pricing raises an important unresolved issue with respect to the Secure Act. Yes, there is a safe harbor for the selection of the annuity provider. However, the pricing decision could be a backdoor into an analysis of the quality of the annuity provider. That is because there's a significant correlation between the price of an annuity contract and the strength or credit quality of an issuer. What happens if, in an effort to keep pricing down, plan sponsors, go with annuity providers of lesser credit quality? We don't know how this is going to be resolved under the Act. At a minimum, given the volume of litigation in the ERISA area, which I'm going to get to in a minute, it will behoove plan sponsors to really have undertaken robust due diligence as to the selection of the lifetime income providers. Two last quick points about the Secure Act. The Act provides for portability of benefits among plans. Previously, this was not allowed, but this is important given the high mobility of today's workforce. And so the Act allows for portability. And then the last point, and I apologize, this is a technical one. I need to introduce a piece of jargon in the retirement space, and that is QDIA. QDIA stands for Qualified Default Investment Alternatives. In other words, what happens if a plan participant fails to make any elections under their plan? Which, by the way, a huge percentage of plan participants don't make elections. They can be defaulted into certain investment options. Back in 2006, President Bush signed the Pension Protection Act, which authorized target date funds as qualifying for QDIA status. With this designation, the floodgates opened, and TDFs today are the largest and fastest growing product in the retirement space. The Department of Labor provided guidance indicating that the addition of guaranteed income components to a TDF product will not jeopardize QDIA status. Another huge sigh of relief from the industry. Here we have what I like to refer to as the triumvirate of fiduciary obligations: duty of loyalty, duty of care, and acting in the best interest of plan participants. No matter what decisions you are considering as a fiduciary, you must run through these tests. The duty of loyalty, essentially no conflicts of interest. You can't represent another party with adverse interests. Duty of care, prudence, defined as prudent expert. What decisions would another expert in this field make? This goes to the due diligence and analytics undertaken for making a fiduciary decision. You cannot just rely upon advisors and consultants. And then best interests of plan participants. No acts of self-dealing. This often refers to the plan sponsor in the case of selecting managers or investment products. Sometimes when you sit on a fiduciary committee, there can be a tension about what does the plan sponsor want and what is in the best interest of plan participants. Then this last concept is a critical piece that's really developed over the years by the courts: procedural prudence. Fiduciaries must have procedures, written procedures. You have to follow them. And all actions, meetings must be documented. If you take away nothing else from this webinar, it's document, document, document. I referenced before litigation. The floodgates have opened. In 2021, there were over 100 ERISA cases filed. And where it used to be that cases were primarily directed at the multi-billion-dollar plans, we have seen that cases are now being filed against $100 million plans. The universe is wide open. There is a cottage industry of lawyers and consultants who mine data simply to uncover potential litigation targets. In fact, you may be aware, one large target date provider had 15 lawsuits filed against the various fiduciaries who adopted the product. These are cookie cutter lawsuits. It is out of control. And fortunately, a couple of the suits have already been dismissed. The most frustrating part of this avalanche is that there's little consistency in the results. Holdings are all over the map. You would think that selecting plans with good performance and low fees would provide a solid defense. This isn't true. But what is providing effective is fiduciary excellence. The procedural prudence I mentioned a minute ago is key to prevailing in these cases. So I've provided a lot of background, some history, as well as the principles of fiduciary decision-making. Dave is going to walk us through an overview of the types of products that are developing. However, before he does so, we have another polling question. That is the retirement plan for which you are a fiduciary considering adding guaranteed lifetime income options. I forget from just a minute ago to the results just pop up on my screen.
We're still tabulating.
Great.
Anyone
Great.
who hasn't can complete the poll, and then we will show the results.
Great, thank you. Okay, 25% are and 75% aren't. Again, this falls within our expectations. This is a new industry that's developing and a new product line, and plan sponsors are engaging in long lead times in considering these products. And so with that, Dave, please walk us through how the market is developing.
Okay, thanks, Mitch. Good afternoon, everyone, and thanks for joining us today. I'm going to actually circle back to a graphic that Mitch used in one of his slides at the beginning to demonstrate that the move of retirement plans was from defined benefit plans to defined contribution plans. I'm going to say 401k instead of defined contributions, if that's okay with everybody. This graphic emphasizes the fact that the risk was actually transferred from, as a result of this transition, the risk was actually transferred to employees, or what we refer to as plan participants. I've divided the risk into a couple of categories: investment risk and retirement income risk. It's all investment risk, but I just categorize it differently. Basically, what I'm talking about here is the responsibility for managing the investments is now with the participant. At the end of the day, they make the decision. For instance, that's what I mean by self-directed asset management. An employee can allocate assets to any of the menu options in a retirement plan. So they have complete freedom to do that, but there are also other ways that they can get some help or professional advice with that. A typical vehicle is a managed account where a professional actually manages the asset allocation for the employee. A couple of other options that everybody's familiar with would be a balanced account, just a 60-40 allocation, or a target date fund, which manages the allocation over time. Another key component here is that the capital invested here is the majority of it comes from the employee, not the company. Retirement income risk, really, in the past, the emphasis has been on accumulating as much wealth as possible up until retirement so that you would have that amount to spend during retirement. Very little attention was given to how do we decumulate this. And also, a defined benefit plan has a guaranteed payment over the lifetime of the employee. In a 401k plan, prior to this, these lifetime income products, that guarantee doesn't exist. As I mentioned, after retirement, the tricky part is to come up with a plan to spend that money over time and make sure it doesn't run out. This is a pretty complicated process. As a matter of fact, Bill Sharp had a very interesting quote about accumulation. He said, "It's the hardest, nastiest problem in finance." That's a pretty strong statement for somebody like him to make. Retirement income products are a step in the right direction because they do add some predictability to retirement income. They don't solve the problem, but it is, as I said, a step in the right direction. I wanted to identify a few risks and the time periods where those risks are relevant here. I have 3 phases identified from 40 years before retirement. So an employee starts at, say, age 25, 40 years after retirement. We have the accumulation phase. That's right up until retirement. So that's when you're trying to maximize the value of your retirement account. You have retirement itself, and then the accumulation phase or the spending phase. During that full period of time, asset allocation is always a risk that has to be managed right until the account has $0 in it. As we approach retirement, the sequence of return is a risk that becomes more important. Sequence of return risk really is the risk that there's a decrease in the balance of the account, market activity, et cetera, that lowers the base on which withdrawals are made. Once withdrawals start, the base continues to lower, so it's more difficult to earn back to a higher level. You need a higher rate of return. And the final one is longevity risk, and that's simply people are afraid they're going to outlive their money. Now, plan participants, their biggest fear is running out of money. It actually changes their spending behavior in retirement, but they really want guaranteed income to supplement either Social Security or any other benefits that they have, but they want to be able to pay their bills in retirement. Now, annuities can do that. They can provide guaranteed lifetime income. Annuities have been around. Keith, we're going to switch to the next slide. Annuities have been around forever. So why aren't they more prevalent in defined contribution or 401k plans? I have a list here of what plan sponsors have said the reasons are. There is a debate whether they're myths, whether they're real or not. But the one major one, and Mitch talked about this earlier, is that plan sponsors have historically had liability for selecting the insurer. The Secure Act gives them a safe harbor as long as they meet certain requirements. These other ones I'm not going to read through. We're going to talk about them later in the context of specific products. I just wanted to list them out to you though, because these have been identified as the barriers to adopting lifetime income products. Annuities aren't the only solution. We've got three basic types that we've looked at. First of all, securities are market-based. These are typically publicly traded securities. You may be familiar with retirement income funds, which is essentially, after retirement, is a managed account that is managed specifically to the participant's need by a professional to be able to sustain withdrawals over the lifetime of the retirement. As I said, those are publicly traded securities. We have insurance-based solutions, which are guaranteed, but these are individual contracts. And as Mitch noted, these contracts are governed by the state, individual states, not at a federal level. And then finally, these are the more innovative products where we blend these two together. And this is the type of product that we're seeing now. Before adapting a solution, a plan sponsor has to decide, first of all, I want to give, how am I going to deliver this? I would like to give, Keith, we're going to flip the slide there. I would like to give my participants the option of retirement income security. However, I can do that out of the plan or inside the plan. The difference between those two, if it's an in plan, then all fiduciary standards apply to that. If it's out of plan, the contract is between the participant and the insurer. I'll give you an example of an out of plan option. It's a simple individual retail purchase. Any one of us could roll the balance out of a 401k plan into an IRA and then buy an annuity. That's very commonly done, but those tend to be expensive solutions. In response to some of the demand for retirement income, plan sponsors have said, well, I don't want it in plan, but I'd like to give my participants an opportunity to participate with this. So what they've done is on the way out, when people are retiring, you can convert a portion of your balance to an annuity and take advantage of institutional pricing so that you're not paying, up to 100, 150 basis points more for that option. Those are the out of plan options. The in plan are where we're going to look at today, where we see the more innovative solutions. And these are the solutions that I think really have legs. And these are the ones that are going to be adopted probably first. The first one is target date funds. Most people are familiar with those. What I have here is a theoretical glide path for a target date fund from 40 years prior to retirement right up until retirement. Typically, you see two asset classes in general. equity and fixed income. The equity allocation is high earlier on. As the participant ages, the risk is reduced by lowering the equity and moving it into fixed income. What the lifetime income product providers have done is created a new asset class. You'll see shaded in the light green, a portion of the fixed income allocation now can be allocated to what's referred to as a fixed income alternative. Essentially, the participant is purchasing a stream of income in the future at a guaranteed rate. Over time, you'll notice at retirement minus 10 there, roughly the middle bar where the light green comes into the graph. They start purchasing at that point and basically dollar cost average into that asset class over time during varying interest rate environments. At retirement, in this example, they have about a 30% balance in the fixed income alternative, and that's the balance that can be converted over to an annuity at that point. Once they convert to an annuity, again, the contract is between the participant and the insurer. There are differing allocations and different target date fund products here where you can actually go up to 100% of the fixed income alternative by the retirement date. I just took a hypothetical one here. You can see though how this mitigates the sequence of return risk because you're actually shifting into a guaranteed asset class 10 years prior to retirement, at least a portion of it. That lowers exposure and lowers risk over a period of about 10 years. And finally, once you purchase this product and have a balance in this account, you have engaged in a lifetime income guarantee. So longevity risk is not completely gone because you're not converting your whole balance, but it goes a long way to guarantee that you have some level of income in retirement. Now, I just want to mention that 80% of plans offer target date funds. So a target date fund solution is a natural fit. But it's not the only one. Another option that exists is a guaranteed income account. This is offered through a managed account. So a participant would choose a managed account option, and then they could purchase this account. What this is a guaranteed minimum return account. It's similar in principle to a stable value portfolio. And essentially what it is it's an insured portfolio. As I said, there's a guaranteed minimum return on the account. In this particular example, this product, the company has a cost advantage. And in the event that they have excess surplus in a certain year, they can allocate that back to the client or to the participant. So in many years, the return is higher than the minimum return. It's a nice little bonus, but this portion of it is not guaranteed. When the participant reaches retirement, they have the option to annuitize, but they are not required to. And finally, the best feature about this account, I think the best feature is it isn't a managed account. There's maximum flexibility. A client or a participant at any time could say, my allocation to this account should be 60% to complement other portions of my portfolio, either that are in the 401k or other assets outside of there. So it really is a very flexible option. Managed accounts have been around for a while, but this is the first time we're seeing lifetime income options introduced this way. So now a plan sponsor will be asked to sit down with the plan sponsor and work with them, see how they can integrate this into their plan. And it's important to understand the demographics of the plan before we could recommend an option. But this is an example of a qualitative analysis that we would do to figure out what is the best option for the plan sponsor. I just want to make a note. You can see how a retirement plan for say a tech startup might be different from a retirement plan for, say, a utility. There's differences in ages, income levels, contribution levels, et cetera. So it's important that we explore several different options for a plan sponsor and look at the attributes and see where's the best fit. So I've lined up these three examples. We talked about target date funds and a guaranteed account. There's actually two pieces to the target date here. They're two separate products, and I just want to highlight that. The guaranteed account, in all cases, the retirement income is guaranteed. So they're the same across the board. The investment return, however, is not. In the guaranteed account, we have that minimum guaranteed, plus a bonus every now and again. But with target date funds, there is no guarantee in terms of the return. The investment growth potential, though, is higher with the target date funds. Guaranteed account is guaranteed at that rate. And so you're going to see a lower return typically over time. And along with that goes the volatility. That's a much steadier product. However, you'll see higher, and this is relative to that product, you'll see higher volatility in both of the target date funds. In terms of asset allocation, I talked about the managed account. That's ultimately flexible. You can allocate as much as you want to that guaranteed account. Target date funds are usually driven by a glide path, and there's usually a fixed glide path, which is the strategic piece, but some target date funds also have a tactical portion. It's usually an investment above or below the targeted level for, maybe 5 to 10%, that is really designed to take advantage of a short-term trend in the market. All of these products, two of the products have the option of annuitizing at retirement. Guaranteed account and target date fund, you have that option. You are never required to do it. On the third option here on the target date fund, there is no requirement to annuitize at all. The client is invested in a portfolio of annuity contracts, and that piece of the glide path determines what their benefit will be. In this third target date fund, you do not have to annuitize to take advantage of that guarantee. The purchase of those contracts over time gives you access to it. And that's a distinguishing factor for that product. Finally, liquidity. Liquidity is really defined as access to your full balance at any time. In the past, with annuities, if a client purchased an annuity, they locked in and they no longer had access to that capital. In all three of these products, there is full liquidity at all times. Now, if a participant annuitizes after retirement, that balance, you need to withdraw from that balance to realize your liquidity. And of course, your retirement income benefit is going to go down as a result of that. But you do have full access to any funds that you would need for an unexpected expense or something like that. Now, the attributes shaded in green are not strictly investment related, but they're important. The number of insurers that back up the guarantee. In the guaranteed account, it's a single insurer. It is a very large, top-rated insurance company. However, it's hard to argue that that's less risky than target date funds. And in these cases, these target date funds have between 2 and 7 companies that are backing up these guarantees. So if you have a default in the first case, it's 100% loss. In the target date funds, it wouldn't be 100% loss. Now, the pricing, Mitch talked about this a little bit. The pricing is an important issue too. Since it's only one contract in the guaranteed account, that insurance company has to remain competitive with those prices in order to be able to issue those annuity contracts. The other 2 target date funds have really responded to this need for security, risk, effective pricing. So what they've done is establish an auction process. When a purchase of a contract needs to be made, it goes out for bid to all the providers. Now, it's understood that those providers pass certain tests in terms of security and credit quality, et cetera. But this auction process really starts to look like a market-like pricing process. And that's, in terms of pricing, that's much more efficient and probably desirable and does help lower the risk. Finally, a couple of qualitative attributes. The complexity for the participant. It's important that participants understand what they're investing in. The options here that I've identified certainly don't represent the full spectrum of products out there, but I identified them because I do think that they're more likely to be introduced to the market sooner than other products. And one of the reasons is it's easier to explain these to participants so they know what they're investing in. And finally, I just noted what vehicles these solutions can be delivered through. We have the managed account and the 2 target date funds. A plan sponsor has to look at all of this, but there's more to do. A lot of work needs to be done in these 3 areas. The first, and in my mind, the most important, is figuring out how to benchmark the performance on any product that contains a lifetime income option. Let me give you a simple example. For target date fund now, you typically have the prospectus benchmark, you might have a reference benchmark, and then a peer benchmark. People would argue that they may not be perfect, but at least it's a ballpark. For lifetime income options being integrated into target date funds, we're going to have to be very careful because a plan sponsor is required to monitor, has a duty to monitor legally performance of the products that it provides in its menu. We're going to have to be careful about how this develops. How can I tell if a lifetime income product is doing well against its investment objective, but also against the competition? There's a big variety of these products out there, and this is going to be one of the challenges. Investment management fees, that's standard because it's a concern, and it's what a plan sponsor is required to monitor these fees to make sure that they're reasonable for the services that the participants are receiving. In general, I can state that these lifetime income products have really reduced the cost of participating in that quote unquote asset class compared to what fees were charged on annuities in the past. So overall fees are down. That's the bottom line. But a new mechanism has to be developed to monitor these fees going forward. Finally, portability. Mitch mentioned this as a component of the Secure Act. The idea is a plan participant or a plan should be able to move their assets or their plan anywhere they want. In the past, there have been situations where a participant had a lifetime income product and they were leaving the company. They would be forced to take a distribution at that point because the product wouldn't be available to them on another platform. The plan is in the same position. If a plan decides to switch record keepers, that's a huge undertaking. And the requirements for keeping track of the transactions involved with lifetime income products are different than a mutual fund. It's not just a question of number of shares, CUSIP, and price. The system infrastructure has to catch up here, and they are doing that. It's requiring a lot of funds, a lot of capital to be invested, and it's going to take some time. A new concept has developed, which I think certainly has potential. It's the concept of middleware. And the way I think about this, I think about it as the annuity cloud. Basically, all annuity transactions, balances, prices are stored in this cloud. And the plan sponsor, the participant, the record keeper, the investment manager connect to that cloud. So the data doesn't really have to go anywhere. Ultimately, it's the database. Again, that is in development. It's not broadly used right now, but that's a different concept, and that's probably going to lead to a pretty promising place. All right, at the end of the day, offering these products really does help reduce some of the risks that participants bear on their own right now. And we are really in the early stages of development here, but there is a lot of effort behind this. It's been going on for years, several years now, and we're going to see more and more of this. And plan participants are very sensitive to this. They want it, and plans have to respond. But as you can see, the lens that a plan sponsor has to view this through is the fiduciary lens, and that's pretty complicated. It's evolving. We have to keep up, and a plan sponsor really has to step up the game in being able to analyze these products to add them to their plans. I'm going to finish there, Mitch, and toss it back to you to sum up.
Sure. Thanks, Dave. There's really an enormous amount of information that you organized and covered for us. So thank you very much. So we started with the evolution of DB plans to DC plans and our prediction that lifetime income products are going to be the next structural shift in retirement planning. We looked briefly at the Secure Act and where it provides a safe harbor and where it doesn't. We also reviewed the fiduciary standards for adopting lifetime income products. And lastly, we looked at the evolving marketplace for lifetime income products, looking at managed accounts and variations of target date funds. Hopefully, we've given you a glimpse into the complexity facing plan sponsors. We love talking about these issues. So afterwards, if you want, feel free to reach out to us. But we have a few minutes left. So now I'd like to open it up for any questions, if there are any.
So I haven't seen any questions yet that have come up, Mitch. But one of the questions that I would have has to do with the performance analysis. Dave, you hit upon that. And I have a question about performance analysis, how you do that. Can you use absolute benchmarks or something like a T-bill plus 2%? Is that an acceptable benchmark? And then what happens with inflation? Can you use inflation as a benchmark? Oh, you're on mute, Dave.
I'm sorry. I'm going to give you a question that you're not going to like. I'm going to give you an answer that you're not going to like. It clearly depends upon the implementation. But let's talk about globally. Let's separate the lifetime income component out because I've seen this recently. Let's say there's a managed account that has a lifetime income component to it. There's a couple of layers there. Managed accounts in general, there's still a question about how to benchmark those because they're custom. So the question is there. Now for the lifetime income component. In the past, there have been attempts to do a standard benchmark or peer-to-peer, but it doesn't quite apply because it is a custom benchmark. So the most recent idea, and I think this has some merit, is at any given point, take the balance and say, what does that turn into in lifetime income for this participant? And how does that line up with what they need? So that's at least a very base level to measure lifetime income or the performance of the lifetime income product. It's not really measured in a return like we normally think about, but the goal is, the real benchmark is how much they need to spend every month in retirement. So I know that's not a full answer, but that's about as good as it becomes at this point. That question is going to have to be answered by the providers of the product. How do I benchmark? How does a plan sponsor make sure that you're hitting your targets? And it's not good enough just to hit your targets because you might set that low. So it's complicated, but that's why we have to do a lot more work in this area.
And actually, the benchmarks seem like they would be customized to each individual. It's not really an index, if you will, out there.
Right, but there's room there to play with the benchmark. I think that's the issue. It might be too easy to beat, is what I'm saying.
Yeah.
So there has to be some objective measure that we can at least get in the ballpark to make sure. And that's, like a peer-to-peer, say on straight target date funds. That's not a perfect comparison, but it's a good ballpark. And that's why you always need more than one benchmark, as you know, to gain reasonability. I just see that this is an area that's going to need a lot of attention.
Yeah. So as a fiduciary yourself, has your research led you to a preference of vehicles, whether it be managed accounts or those target date funds? What's your preference?
Well, I will tell you, I have personal preferences, but I'm not going to name those. I mean, in our role, we really have to be agnostic. I think there are some neater options than others. But again, when we work with a plan, we need to know what they need. And as I gave an example earlier, you're probably going to have a different retirement plan from a tech startup than you are from a utility. And some of the factors are time horizon, size of their accounts, assets outside of the plan. So it really has to be customized. Our goal has been to look at products across the spectrum and be able to compare attributes like I did in that exhibit, bring that to a plan sponsor and say, okay, what's important to you? What are we looking for? And then narrow it down that way. But the answer to your question, yeah, I do have a couple of favorites, but I have to remain agnostic on that.
Mitch, are you willing to share any of your preferences, or is your answer the same?
I think another way of addressing what Dave is explaining, is suggesting, is that the selection of a lifetime income product is really tied to and connected with the culture, the demographics of each plan sponsor. And so you can't just make, frankly, I would say, it's from a fiduciary perspective, it's a risk to say, we think XYZ product is the best in all circumstances. It's just not the case. There is way too much, sort of particularity, uniqueness among different types of plan sponsors. And, that's not avoiding the question. It's really acknowledging the reality and recognizing that fiduciary decisions are, integrated into the culture and the demographics of a plan sponsor.
Actually, so you're kind of naming the next question that I have written down here is, what is the consultant's role in the process? So really, it does depend on the plan. So can you kind of give, we have some time, just like an overview of when you go in, and you've given the examples of a tech versus a utility company. So what kind of process what kind of questions are you asking to determine what would be the best product for that plan?
Well, I'll start with this, and then, Dave, feel free to step in.
Sure.
Our role is to really work cooperatively with the consultants, because the consultants are going to be, and by the way, let's divide consultants into two categories. There are consultants with respect to plan benefits and the structure of plans and plan sponsors, and then there are investment consultants, and we would work closely with both types of consultants. Generally, they are going to be the ones with all sorts of data both with respect to the plan participants, but also the investment data. And then we would be looking, if we are retained, to be the fiduciary to make a decision, we would be relying on the data that we've received from these consultants and our work with the plan sponsor. And then we would be willing to step up as the fiduciary, to sign off on different products. So Dave, do you have anything to add here?
Just a little bit. I mean, consultants play such a big role in the retirement industry. They are trusted advisors, and we would look forward to working collaboratively with them. From my perspective, it would probably be more the data and the research side of things. I think, as I'm speaking, and based on the last questions, I think I could, work closely to develop those performance benchmarks that we were talking about to measure the the effectiveness of the management of the product itself. But that's just an example of, I think, how we could collaborate with them. But they're an important part of the infrastructure, and they're trusted advisors of the plan. So we'd certainly, welcome the opportunity to work with them to produce the best recommendations and or screening for products in the plan.
So I have one other thing I'm going to ask, because some of the poll questions, they showed what you were expecting, meaning that so far people are not looking at these guaranteed lifetime income into the plans. You said you were not surprised by that, but do you think within the next 10, 20 years that will have a place? Obviously it's being allowed, but how much do you think people really want that in their plans?
Okay, I want to be really clear. I'm not a cynic about this, okay? But both the insurance industry and the mutual funds industry are going to be generating huge campaigns, marketing campaigns and rollouts. And they are really good. And the product is good. So, I don't think it's going to be 5 and 10 years. I think that we are just at the start of this. And I think that actually, I think by 5 and 10 years, it's sort of going to be sort of a tidal wave of these products. We saw the way the market reacted to target date funds. I'm having a senior moment here. Target date funds, before they were called target date funds, I think were called lifetime life cycle funds. Exactly. And it took a number of years. And then the market coalesced around target date funds and they exploded. We think that there is going to be a similar type of product introductory cycle. And by the way, one thing I didn't mention, let's not forget, and I say this cautiously, I don't know who's in our audience, the retirement of baby boomers is a gigantic demographic trend that I think is going to push this product cycle.
Yeah, that's probably a good point to make. Well, we are running right up to the time. I want to thank Dave, Mitch, both of you. I know you can't see the audience clapping. Thank you so much for joining us today. If anybody should have any questions, please reach out to CFA Boston. You also have the information here for Keith Flynn, the Chief Marketing Officer of Harrison Fiduciary, if you have any questions. So thank you all for joining us today and happy holidays to all.
Thanks, everyone.
Thank you. Thank you.
Bye-bye.
Bye-bye.
Bye.